again, Pennsylvania. This is Money in Motion with Walter West. He is the founder of West Advisory Group. I am your host, Spike Spangle. Every single week we cover retirement planning strategies. Sorry, Walt, I'm always formal. I always go with the Walter, but you say that's your dad, right?
That's my dad. Yeah, you say that about my dad, but you call me Walt, right? So
I'm going to call you WW. We're going to leave it at that.
Actually, I really like that.
Right? All right.
Short and sweet and right to the point. I really like that, Spike.
Well, what's on your mind today? What's going on with you?
Well, every day is a great day for me. I just love getting up every day and just helping people make better decisions when it comes to planning for the retirement. It's just a really, really so gratifying, right?
Yeah.
So, I'm a reformed engineer, if you should know, right? So
Exactly.
I worked a few years in engineering, but I've been doing this for the last 30 years of my life. And I can't tell you how exciting it is to see big smiles on people's faces when you can transition their life from going from, accumulation phase to the distribution phase. It's just been a great journey.
I love it, Walt, and that's why I love doing the show with you. Today, folks, on this program, we are going to be covering so many different topics for you. We're going to talk about risks in retirement. Everything from inflation, interest rate, market volatility. I know we can cover that today, maybe a few more, depending on how much we get through. Walt, I do want to ask you about that. We've heard the word inflation from broadcast studios for the last year and a half. But nobody tells us what it means. Nobody tells us what we can do about it. We know that our groceries cost more. We know that housing has costed more. We know that going on vacation, everything costs more. But in retirement, what can we do about it? We've stopped working.
Yeah, there's no doubt, Spike, that that's been a major topic today with inflation the last 15 months, running, just so much higher than it had been previously. But, even at the modest levels of inflation has impacts on your retirement, no doubt about it. And I believe that a lot of people don't take enough time to think about the impact of inflation over time, especially if we take a look at people that retiring today. So many people that we meet want to retire earlier, right? 60, sometimes even 55, believe it or not. And they could be 30 to 40 years in retirement. If you're not taking inflation into consideration, you're really shortchanging your ability to be able to buy the things that you want to buy in the future. It reminds me of one of my clients. So one of my clients, I just mentioned, I'm a reformed engineer, right? But she's a very analytical person. And she really wants to get into the weeds when it comes to the planning process. So she started to build a budget for herself, right? And she was saying, well, in our budget, we want to forecast buying a new car every 4 years. So, she built that into the plan about what they pay for a car, right? So, every 4 years, so 12 years out, she's buying another car. She used the same number that she used today, 12 years from now. And I'm like, do you understand?
Not even close.
Right. I said, that number that you're projecting is not going to buy the fender for the car, let alone the car, right? I simply said, rewind 12 years and say, hey, what did it cost you then to buy a car? And she goes, a light bulb went off. She goes, you're absolutely right. But so often people underestimate that. So the idea here is when you start talking about how you're impacted by that and people are unaware of it, they say, well, I'm spending X amount of dollars today. 20 years ago, that number is going to be double. They can't even imagine the magnitude of that number.
The only thing that I've been grateful about with inflation right now is that it's part of the conversation when it comes to retirement planning. I'm not happy about the numbers, but where did they typically run? What normal inflation number had you put into retirement plans before the last couple of years?
So we really look at like that 2 to 3%, right? If you go back and look at even the 100-year average of inflation, even back in the 70s when it was double digit, it's not quite there yet today, but it was then, but we have higher inflation we've had in the last 10, 15 years, right? So, we're looking at about 2.5 to 3%, I think is a good, solid inflation number. Now, what's important about inflation? So when we're building a plan for somebody and really taking a deep dive and analyzing it, we're looking at their need for income going up by 2 to 3% a year, right? The reality is there's none of our clients coming to us every year asking for a pay raise, right? But I will tell you, every 4 or 5 years, there's definitely a meaningful conversation about cash flow, right? Do I really have enough money to do what I'm doing? I'm having more month than money, so to speak, right? So we are adjusting income, but you have to take into consideration, people look at their income number as a number. They forget that they have, the business partner, the IRS, taxes. They forget about, inflation and that erodes your buying power over time. Once people start to see that, then they understand that, okay, I need to think differently about how I see my income into the future. Again, I always say this, it's not what you make, it's what you keep.
Yeah, I saw a number recently on the inflation effect on Social Security from 2000, just the year 2000, that it's lost over 34% of its buying power, even though there are cost of living adjustments.
Yep.
I was about to say every year. It's available every year. It doesn't happen every year. Sometimes 2 or 3 years in a row it doesn't. Last year was one of the highest in over 4 decades, but even Social Security hasn't kept pace with inflation.
No, it hasn't, right? So, it's just something you have to plan. So you have to look at your investment strategy a little bit different to support what that income looks like. You have to own investments that are going to be able to keep up with inflation, right? So those are things like, real estate or inflation adjusted bond type strategies or equities. I mean, they typically pace or outpace inflation. So you have to think about that in your overall strategy to be able to, compensate for what this is all about. But if you look at inflation now, it's probably fast forward itself almost 8 or 9 years.
And my problem is I don't think those numbers are going to come down. I think once the businesses out there are able to hit that higher number, they're not going to retract it just because inflation comes down to a 1 or 2 or 3% again. I think these numbers are here to stay. So for today's retiree, not only is this where the bar is, but you've got to also project it out 5 years, 10 years, 15 years from now. That is hard for folks. For other folks who are not the engineers, how do you help other clients visualize what those numbers need to be?
Well, I'll tell you, one way to take advantage of to really understand this is really take part in the lab session that we offer to all of our viewers out here today, right? The lab session is a dedicated time to really do a diagnostic test on your financial situation. It'll identify if you have money falling through the cracks with the way inflation is going to erode your buying power. Especially if you live 30, 40 years in retirement, you need to be able to see what that's going to look like for you, right? And then you need to understand all the methodologies in which you can take advantage of to offset that risk down the road, right? So I think really getting a better handle on that, because it is a classic example of money falling through the cracks, and you really need to come to the lab session. I think that will really open your eyes, right? Mm-hmm. It takes something that you can kind of, you think about, but you don't really see. When you visualize something, a picture tells 1,000 words, they say, right? But the idea, it's true, right? When you see that, then you can say, well, hey, I'm not interested in this. I can see how my buying power is eroding over time. What are some solutions that I could take advantage of to offset that? Then you can really test. You can stress test your overall plan. But the lab session is dedicated to give you those resources to help put you in a position to ask better questions.
Right. And that is complimentary for our viewers, and it starts with you. You just need to call that phone number down on the bottom of the screen. You will get your own dedicated retirement lab session, taking a look at investments, your estate planning, your healthcare choices, Social Security, so much more, dedicated to you, complimentary for the viewers of this program, Money in Motion. Call 888-585-8701. More with Walt West, financial advisor and the founder of West Advisory Group, right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Money in Motion with Walt West, financial advisor and the founder of West Advisory Group, right here in Pennsylvania. I am your host, Spike Spangle. Today we're talking about risks in retirement. The reason we're talking about them is not to make you nervous about them, but Walt likes to provide solutions, or at least the kinds of things that he helps people with inside the offices every day.
Absolutely.
Walt, here's a big one, WW, interest rate risk. We've been hearing about that for 14, 15 months. We've seen the interest rate hikes.
Yes.
We know what it's done to the housing market, but I haven't really seen it cool off the rest of inflation, which you were just talking about. Are rising interest rates a good thing? And what in the world happened to the bond market last year?
Yeah, so you would like to think the interest rates are, at a good place. I mean, we've seen them go up 20 times last year. I mean, they were basically in the basement for a lot of years, right?
Yeah.
So, in fact, you've seen those people that don't like risk being in these safe investments and had to really move money out of safe investments into risk investments because interest rates were so low. Then here we go. Last 14, 15 months, interest rates have just continued to ramp up, and here we are where interest rates are kind of more normalized, if you will. But why is it happening? Number one, why is it happening? It's because inflation. It's the only reason why it's going up, to curb inflation. Is it here to stay? We'll see, right? We're not sure if that's going to be the case. But the issue with interest rates is, it's really from an investment strategy standpoint. I think people misunderstand interest rates when it comes to bonds, right? For investments. People think of bonds being safe investments, right? Lo and behold.
Absolutely. When there's market risk for 40, 50 years, people have seen their bond values go up, and they were doing that last year. They saw the market volatility, interest rates going up, but the bond market went down. What happened?
Yep. Because what's that? There's an inverse relationship between interest rates and bond values, right? When interest rates up, bond values go down, because the reason for that is when you think about a bond is, I call it loanership, right? You're loaning an institution, you're loaning the government, you're loaning a company money in exchange for some interest rate for a period of time, right? So that period of time, they're going to give you interest over that period of time, right? But now if you have a 3-year bond with the idea you're getting 3%, but now the interest rates are going up, and now you can buy that bond for 5%, what happens to the bond you own? It's worth less money because I can buy a new one at 5%. So the idea is the bond values fall, right? So this is what has happened, but people don't understand that concept. So they say, well, bonds are safe, because that's what they've been told. We're going to move out of equities, we're going to go into bonds to be safe. Well, lo and behold, people did that last year, and we had double-digit losses in bonds like we did with equities, right? So it was not the place to go. But now interest rates are kind of gotten to a place where, we believe they're at that high level, not sure if they're going to continue to go up. Probably start to come down at some point, right? Latter this year, maybe beginning of next year. But the idea being is that, interest rates are in a better place now than they've been in a long time. But I don't think that they're here to stay. I think this is a function. There's a direct relationship between interest rate and inflation, right? Once the Fed believes they got the inflation under control, I think interest rates will start to come down.
Okay. Now, as a financial advisor, and you help people with retirement strategies every single day in the offices at West Advisory Group, can we take advantage of these current higher interest rates? Are there vehicles? Do you like the online savings accounts now that I can see for 5%? Should I be chasing after these returns? Do we want to be going, if we have the opportunity, to now be looking at some of these higher bonds? Or what about other fixed, maybe even insurance products?
Yeah, absolutely. I mean, you look at the landscape today, and you're looking at the industry today, there are opportunities for you to lock in some of these interest rates for a period of time. You just wouldn't want to go too long, right? Maybe 2 years, 3 years, locking them in, but looking for long-term, 10 years, 20 years. I mean, there could be some risk in doing that, right? There's some insurance products out there now being offered much more competitive with some of the rates in which they give you, and especially, with some of the insurance products like annuities, for example, they give you some tax advantage as well as better rates, opposed to things that you might do in the banking industry, right? So, but again, it really is a function of what is the purpose of the money, right? I always go back to that because people ask me where I should put my money or how should I put my money and how should I position this. I always go back with another question. I hate to answer a question with a question, but what is the purpose of it? So that drives the conversation of where that money should go.
And no offense to any of our viewers out there, because I do the same thing, because I think people chase after rates. They're looking at the numbers, and so they call you and say, what did you think about this 5%? What about this over here for 6? This one says it guarantees me 6%, for 10 years. I can withdraw withdraw 10% of my own money every single year. What do you think of that? And you'll always go back to, what's the money for?
Exactly. That drives the conversation. It really needs to, because the last thing you want to do is make a decision without having all the critical facts, and then find out 6 months, 7 months, 8 months later, the decision I made, I didn't understand that was a potential issue, and then you say, hey, what do I do to change that? And it usually costs you more money. So it's best to have a good conversation about what the purpose of the money is first.
Do you mind if I ask you a side question? Did you see what happened to target date funds last year? I think it was also one of the worst years for target date. Can you explain to folks what those are again? A lot of folks are using it.
I think it's important to understand target date funds, right? Because they're plentiful, right? I think every qualified retirement plan, 401k, Roth 4, has target date funds. And usually target date funds are funds that make life a little bit simple, right? Because you can just simply allocate to it. It's actually to be internally managed, but it's managed based on your age, right? Target is the key word there. It's targeted based on your age and when you approach retirement, right? The closer to retirement, the more conservative it tends to be. But let's talk about 2022, right? Well, people that were 60, 62, 63, and own target date funds, maybe 60, 70% of it was fixed income, other equities. Well, that wasn't a good place to be in 22, right? Because again, we just talked about when interest rates go up, bond values go down. So they've seen their target date funds really, taken on the chin, so to speak, because this inverse relationship with interest rates and bonds, right? So here are the people thinking they're going safe by owning those, and lo and behold, didn't work out. It was a perfect storm last year.
Do me a favor, talk to the viewers out. Tell them exactly what the lab session is about. I'm so glad that you can explain these concepts for myself and for your viewers. And it's great to hear it once, but you can apply this stuff, take a look at their portfolios, and analyze it for each individual person's situation, right?
Yeah, I think the lab session is a critical part to get you in a position where you can make better decisions about your finances. The lab session is really a dedicated time for us to meet with you, come to our offices, meet with us so we can do a diagnostic test of your financial situation. It really puts you in a position so you can ask better questions to get the critical facts in what you need, whether it be for tax planning, whether it be for interest rate changes. We've just been talking about how to build an income plan that's sustainable during retirement. And again, or simply just getting those questions answered. So the lab session there's 3 goals in this lab session. Really there are, Spike. And number 1 is for you to get to a place where, number 1, you're going to have more clarity about your financial situation. You want to make sure that your, plan matches your retirement dreams. That gives you that comfort in what you really need, right? You want to make sure you're not putting square pegs in the round holes. Just talked about target date funds. People putting square pegs in the round holes, not understanding the ramification for it, right? And then also you want the confidence to know that all the pieces of the financial puzzle have been recognized, put together to have that clear retirement picture. It's very, very important, right? So if you meet our 3A challenge, you would be best suited for that lab session. Number 1, assets. You're 1 to 5 years away from retirement, and you have the assets, you've accumulated assets to make that transition to retirement. Number 2, that you have a great attitude, right? You're family oriented, you're open-minded, you want to be educated, you want to make better decisions for you and your family. And number 3, you're an advocate. Advocate to buy into a process, not a product. If you fit that mold, you fit the 3A challenge, pick up the phone and call us right now at 888-585-8701.
Couldn't have said it better myself. We're going to talk about market risk. What do you do about accumulation versus decumulation in retirement? How can you protect yourself from the market volatility when you still need to have gains in your investments throughout retirement? More with Walt West when we get back, right after this.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter, the one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to Money in Motion with Walt West, financial advisor and the founder of West Advisory Group right here in Pennsylvania. I'm your host, Spike Spangle. We're talking about retirement risks, and more importantly, Walt is giving us solutions on how to avoid them. Talked about interest rate risk, inflation risk. Now we've got to go to one of the big ones for retirees. That's market volatility. There isn't a lot we can do. How about we look back at last year? Man, somebody who retired in 2022, they might be rethinking their retirement right now. Do you have clients who retired last year?
Absolutely. Well, thinking about retirement last year. So, we met some folks, late in 2021, but the idea was that he was, all excited about making this retirement move in 2022, right? So, we come off this big bull run that we've seen for, 10 plus years. And, he was a pretty aggressive guy. And even though he's nearing retirement, he was of the mindset that, hey, the market's going to do what it does. I've done so well over this period of time. I'm going to keep chugging along, knowing that he wanted to retire in 22. Right, so here we are. The market just went upside down. In fact, because of his positioning that he felt was appropriate for him, he was down 30%. Right, so I had a conversation about that, and I warned him of the risk of market volatility, right, and how it could really impact your ability to be able to retire. Right, so here we are, nearing the end of 22 when he went to retire, and he came to me and he says, "Walt, I don't think I can do it. Right, I don't think I can retire because I'm down 30%, and I'm going to have to delay that now sometime into next year or the year after." What's interesting about that, when you take a look at drawdowns and market volatility, that's really what matters. People always think about the upside, right? But if you're down 30%...
There's two sides to volatility. Everybody loves the upside one.
Exactly.
It's the downside volatility.
Couldn't have said it better.
It's such a shame to have to continue to keep working. Maybe they were set for it. Maybe they had saved enough. Another article I just read this morning is there were over 800,000 people who turned into unmillionaires last year.
Yep.
Meaning that threshold of their assets, and that 100,000 or so with somebody who has $1 million, that's the difference between retiring and now. We're not talking about 20 million, 50 million, 100 million dollars.
Exactly.
When you're right on that threshold, that can set you back a whole nother 2 or 3 years. Because how long is it going to take them to make back 30% in losses?
Well, on average, it takes almost 60 months, 5 years for that to come back, right? So, some will say, maybe watching this program and say, well, wait a minute. In 2020, when the market went down 34%, it was back in like 8 months. Okay, that was an anomaly, folks. The idea that
Right.
doesn't typically happen that way. There were circumstances in which, here we are, that took place. But the reality is when you go back to the beginning of time and look at market volatility, it takes time. So how many 5 years increments of your life do you have to throw away to wait to use your money again? You know what I call that? The just-in-case retirement. You're letting the market dictate your future when it comes to retirement. Makes no sense, right? So we typically offer everybody a lab session that goes through those details to understand how market volatility can impact your retirement, right? And when you really start to visualize that and see that, you start thinking differently about risk, right? Even though we had a great run, but all good things sometimes come to an end.
I like to point out, I talk about it as well, the longest bull run in American history as far as time, nearly 14 years. But there's a reason why it was such a great bull run. Because we were in the basement in 2008 and 9. There's no place to go but up.
Yeah.
So of course things did well for a long time.
Yeah, and that talks about market performance. I just want to point on that because I get this all the time. People say, well, I'm doing, 10, 15% of my investments. They're really excited about that. But they look at that number from the bottom of the basement, as you said, in 2009 to maybe up to 2021, right? But if you really, look at this thing through a telescope, focus out, you look at over a 20-year period, the market's only really done 5%, right? The 10 years preceding that did nothing, quite frankly.
And then it was the lost decade of the early 2000s, right? So there was a big, huge misnomer, I think, of people thinking that your investments will always come back up. Yes, you talked about the black swan of 2020. 2008, it was because there was no place to go but up, but really, the market's over time. So to make this back up, we have to take into account volatility. On today's program, Walt, you have covered inflation risk, interest rate risk, a bit on market volatility. I know that we can put up the phone number here. We want people to start their own lab session, their own retirement lab session for you. Phone number 888-585-8701. We also have a QR code. I'll explain how to use that as we wrap up the show. But who would be best? I mean, for folks who are worried about interest rate, inflation, market volatility, who's the best person? What makes a good composite person to call that phone number?
Great question. Those that are best suited for a lab session really meet our 3A challenge. First A is assets, right? You're 1 to 5 years away from retirement. You've accumulated assets. You feel that you're in a good position to make that transition from the accumulation phase to the distribution phase. That's test number 1. Number 2, you have the right attitude. The attitude saying that, hey, I'm open-minded. I want to know more about so I can make better decisions. I care about my family. I want to maintain my independence and my integrity. So that passes A number 2. The third challenge is advocacy. You're looking to buy into a process, not a product. If you meet the 3A challenge, pick up the phone, give us a call, call 888-585-8701, schedule that complimentary lab session, 60 minutes, come into our office, and we'll really go through a diagnostic test to help you make better decisions.
And in that diagnostic test, I just want to be clear for folks, investments, which would include fees, risk, and allocation. You will talk about taxes. I know you've covered taxes before. You're a recovering engineer. Yeah. You like to play with the numbers. We'll also talk about health choices, Social Security, possibly even estate planning. That's a lot to pack into 60 minutes.
No doubt. And all that is very important because it's that putting all the pieces of the financial puzzle together to give you the perfect picture of retirement, right? So you got to look at all these pieces. You can never silo what it is you're doing because one thing will affect something else. You need to understand how you'll be impacted by all the things you just mentioned. And that's what comes out of the lab session. So you position yourself with confidence and you give yourself the best foot forward to have a rewarding and fulfilling retirement.
Well, Walt West, I know that we have to cover a lot more of the retirement risk. We'll continue to do that in other programs. Folks, one more thing I want to point out to you right now. If you want to use the QR code on the bottom of your screen there, open up your cell phone. I know you're flipping through it while you're watching the program. Open it up to the camera function, point it at that black and white box down at the bottom. When it activates, click on it. It's going to take you right over to Walt's website. You can answer a couple of questions. You can schedule yourself to come in for an appointment, and you can find out more about Walt and the team right there on the landing page. Or call the phone number you see right here, 888-585-8701. Thank you for watching Money in Motion with Walt West. We'll be back again next week.